We just have a quick question here from Fahar asking us, where is the best place to place a stop loss for a day trade? Is it below the first or the second swing point? So first of all, thanks for the question, Fahar. Now, when looking at stops, we prefer to, again, keep things very simple. But we also do prefer to give the trade enough space to play out and don't usually like placing very tight stops for that reason. So looking at, let's look at the NZD CAD for today, for example, we preferred a entry somewhere in this overall a support area. And that would mean that we would look for the most recent swing for a potential stop loss. That is the general consensus out there, but we don't really like to use that first swing point because that is where most people will have their stops for that trade. We like to use the second swing or the second fractal away from the entry for our stop loss. Now, having said that, even though we prefer the second one, sometimes we might consider a first swing or even a third swing away if there is a, let's say, a major key level that would be a better anchor for a stop. So for example, let's say we wanted to place it here, but then we see there's a major psychological level, we might decide to take it just a little step back. Or let's say between this level and this level, there's a major psychological level here, we might prefer to place it just below that level instead of that swing. So it does differ. Apart from looking at the second swing, we also look at the ADR, of course, or the average daily range for the particular pair. Now, even though we like using that second swing, in a general sense, the ADR might mean that we can consider a first or again maybe a third swing away from the entry based on the ADR of that particular pair. So, for example, if we take an entry and the first two swing points is well within that ADR range, so let's say we took this entry, but the ADR low is sitting, somewhere over here, then the highest probability opportunity for us to use for a stop loss would be outside that range, which would mean the third swing away from the entry. Now, apart from that, it's also important to remember that we like to trade unleveraged or with a one-to-one leverage. Now, that means for every $1,000 in your account, you can only trade one micro lot. For every $10,000, you can only trade a mini lot, etc. Now, that way, roughly speaking, 100 pips movement will always equate to about 1%. 100 pips will normally equate to about 1% of total movement of your account. So having said that, there might be times that the volatility of a pair might mean that your stop loss can be 200 or 300 pips away for a day trade, which if your stop was it and you traded at a one-to-one leverage, that would equal to like 2 or 3% loss, which is a little bit excessive for a day trade. So in those cases, you can simply beta adjust your position for the volatility. That means even if your stop loss is, let's say, 300 pips away, you can adjust your position or your lot size so that you can only still risk 1% or less than that for that particular trade. Now, this might even be helpful for a more flatter equity curve as well. So due to the distribution of your trade. So what I mean by that is, let's say you take a trade on the euro US dollar and you also take a trade on the pound Aussie. Now, the euro US dollar might only move 70 pips a day, where the pound Aussie might move 400 pips a day. So trading a one-to-one on both of them would mean that you are taking a much bigger risk on the pound Aussie just because the volatility is so much more, so that it might be better to beta adjust that position to bring it more in line with the average daily range of that particular instrument, again coming back to that ADR. So another important point to consider for stop loss placement is the sentiment itself, which often provides the very best stop loss for a trade. So for example, the moment the sentiment for entering a trade changes, that's normally the best time to use as a stop loss, to just get out of the trade. So personally, I always have a hard stop in place for my trades, but I very seldomly allow that full stop loss to be hit, because normally, whenever you see the sentiment moderate or a change in the sentiment, you can just go ahead and take off that position because the reason why you entered has changed. So think of it that way. The actual reason a stop loss is there is really just for you when you can't be at the screen to closely monitor that position. So let's say you're at work and you can't monitor it, or there is a major unexpected volatility event that causes huge spikes. In those cases, you want that stop loss there to protect your account. But normally speaking, what you do is you would basically just take that off the moment the sentiment changes, and not necessarily at that hard level. So I hope that helps you out there, Fahar. Obviously, if there's more questions about stop losses, don't hesitate to let us know.